You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by Tradier, a REST-based open and secure API for investors, advisors, and traders. Open a Tradier brokerage account and trade the way you want with competitive pricing and a unique API. Learn more at Tradier.com. And now, let's get you into peak options trading shape. It's time for Options Boot Camp.
Welcome back to Options Boot Camp, the program where we help you, the busy trader. Maybe you're new to the options game. You come in from the stock world. Maybe you've tried them a little bit. You haven't liked your results so far. You want to learn how to trade them better. Either way, we've got you covered here. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the ever-exciting The Options Insider Radio Network. And joining me on the old program today, once again, my cohort, my fellow drill instructor / nemesis in life, Mr. Dan Passarelli, the founder over there at Market Taker Mentoring. Welcome back to the program, my lifelong nemesis, sir.
Good to be here, Mark.
All right, you ready to bust some myths, sir?
Let's do it.
All right, here we go. The little bit of your basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Pull in, print bear to learn.
All right, everybody, welcome to your basic training. This is the portion of the show where we break down some basic options concepts, or in this case, we're going to do something a little different because it was fun last time we did, and we haven't done it in quite a while. We're going to bust some options myths. Hopefully those guys over there on used to be on the Discovery Channel don't sue us, but it's time to bust some myths. We have a lot to get to. Let's see how many we could squeeze. I'm sure you probably have a few of your own you've encountered over there, Dan, over the years. But, you know, we did that episode a few back about doing income trades, you know, covered calls, short puts, and a lot of the feedback and what we heard and what we see. And just even doing that episode, it made us think of this first myth, which is an interesting one, and one we encounter quite a bit. You know, people covered call. What is your typical covered call? Well, XYZ, right? You buy it, it's trading 50, you like it, you want to get a little bit of additional income. Maybe you're okay selling the stock, so you turn around and sell that covered call at the 55 strike. So now you have a position where you own the stock. If it rallies up to 55, you agree to sell it away. You keep all the appreciation between 50 and 55, and then you get paid at the end of that to sell it out with whatever you collected for that option. So it's a very easy to intuit type of trade. Everyone likes it. A lot of newcomers to the options world from stock, that's pretty much their first trade, the covered call. And the way they always do it is pretty much the way it is outlined. Some out-of-the-money strike that they turn around and write. But so the myth is, I think the perception out there is that you can pretty much only write covered calls. They're only covered. They only work if you write them out of the money. And yet, that is not the case. Listeners, it is possible. It is legal to go in and write an in-the-money covered call. Now, why would you do such a thing? Why would you embrace such madness there? 'Cause obviously, a covered call, usually you want a little bit of appreciation to the upside. You want to let your stock run a little bit. You're selling an in-the-money covered call. What does that mean? Well, you're selling a call below the at-the-money strike. So if XYZ is trading 50, maybe you sell a 48 strike call, $2 in the money. So all things being equal, if XYZ sits there at 50 until expiration, you will sell that stock. You will be selling that stock. Why would you do such a thing? Well, a couple of reasons. First off, maybe you want to sell the stock, in which case you don't just want to hit the bid. Maybe you want to get a little bit extra bang for your buck. So instead of selling the stock outright, you're going to sell the option because obviously there's time value in that option. So you're collecting all that in addition to selling the stock. Now, the downside to that, of course, instead of just hitting the bid in the stock, is that you haven't sold the stock yet. You have to wait till expiration, and a lot can happen between then. Obviously, the stock rallies, you'll sell it out. If it stays where it is, you'll probably sell it out. But if the stock drops, which is maybe what you were hoping to avoid by selling the covered call to begin with, you're gonna participate in that because you still own the stock. So you'll have a couple of dollars worth of cushion now to protect you, which will be nice, but you're not hedged to the downside by any means. So that's one of the downsides, pun intended, of this type of strategy. The other reason people like to do it is, of course, because the put wing, the put options, remember, we talked about volatility skew on this show in the past. I encourage you, if you're not really familiar with that concept, go back into our archives, look for volatility and volatility skew. We do deep dives, hour-long dives into those concepts for you. But in general, the level of volatility that the puts trade at versus the level of volatility that the calls trade at, in most equities and equity indices, the puts are going to trade at a higher level of volatility, which means if you're selling calls in the money, you are trading below the at-the-money strike. You are effectively trading on the same level of volatility that those puts are trading at now. So you're getting a little bit more bang for the buck than you would be at a similar out-of-the-money level for a call. If you sell a 5% in-the-money call, for example, versus a 5% out-of-the-money covered call, you can get more from a time value, from an extra intrinsic value perspective on that call and the in-the-money call than you are on the out-of-the-money one because of that skew factor that we just accounted for. So over time, that could actually add up. So there are people I know out there whose sole use case for covered calls is in the money. It is an effective way to go, as long as you know some of the limitations. Mr. Dan, and I know you probably lean to the traditional out-of-the-money covered call route. I'm sure that's where a lot of your students go. But do you ever counsel them to go in the money? And if so, why, sir?
Yeah, I do sometimes. That's part of our MTM Smart Income Investing system. There's a few different reasons for it. One of my favorites is, and we talked about this on a previous show, that covered calls basically have to be traded as a system for it to be worth your time, and then it becomes potentially extremely worth your time. And what I'll do a lot is I'll have on a covered call, and it's one of those times when the stock or ETF rises up through your strike price, and you're in a situation where, oh, geez, I'm leaving money on the table, but that's okay because that was my objective. Like I'd be okay selling if we got to the strike price, but I'd rather make more money than less money. So what I'll do sometimes is I'll just buy that call that was originally out of the money. I'll buy it back. A lot of times it'll be for a small loss. And then I'll just sell an at-the-money or slightly in-the-money covered call the next expiration cycle out. Ideally, there's weeklies. And then anything I lost on this first call, I make back, because I took in another premium. And even though the strike now would be at the money or slightly in the money, it's a higher strike. So I get to sell the stock at a higher price when I get assigned. That's I call that my secret roll to trade strategy.
Roll to trade. Look at you with the little secrets over there. That's why you pay the big bucks at MTM, listeners. So you can go head on over there and learn these secrets for yourselves. So let's bust a few more myths here. Number 2, Dan, this was kind of inspired by a question we had on a recent episode. Because you and I even we had to think about it for a minute because it is an interesting kind of subjective one. And the myth is that the pros, all they do is sell options, right? They come in, all they do is hit the bid on options. Time decay is your friend. You want to collect it. You and I have both heard all the old saws when we were on the SIBO. Options are insurance. You make money selling insurance, not buying insurance. When in doubt, palms out. That was another big one down there on the floor of the SIBO. I used to have in my old cohorts on our Volatility Views program. He used to always say, old school Morgan Stanley derivatives hand, been in the volatility trading game for years. He used to say options are for selling or not selling. he would physically throw open his mouth if you made him buy an option. So there certainly is that contingent out there, listeners, and their reasons are pretty plain, I think. We talked about it before. Time decay is a real factor in options. And certainly if you're selling options, time decay works in your favor. So that's a very attractive thing. And for that, a lot of people, that's kind of their primary use case, is harvesting that risk premium, as we like to say. It could be through short puts, put spreads, covered calls is another popular one. And, of course, a lot of variations on spreads that harvest premium through a variety of different MOs. But, as we've kind of outlined here on this program and hopefully on this network, the term Pro A, that's debatable what that actually means. Could a super active retail guy be effectively a semi-pro or a pro? Yeah, sure. Does it mean a guy on a trading desk somewhere? Does it mean a market maker, a hedge fund, prop shop? All those can be lumped in together under that title of pro. So that term in and of itself is a little bit dubious. But we've always advocated for a multi-tiered approach here, which is why we view this as a myth, because there's different environments. And you don't want to do the same thing in every environment. Imagine if you're a carpenter and all you got is a hammer. You're not going to be very good at building a house. You can help put up some of the walls and things, but when you got to start putting in some screws or other things, you're kind of out of luck. And that's kind of the similar analogy here for options trading, where if you approach everything through I have to harvest, first off, it's going to force you into some positions where you're selling options where you probably really shouldn't be. The risk reward simply isn't there. And one of the good ways to gauge that, of course, is looking at your historical level of volatility over time. Volatility cones are a great tool for that. So you can see exactly where your volatility levels are on a historical basis. So if you're selling the absolute nadir of volatility in that product, maybe you want to back off. Doesn't mean you have to buy it, but maybe you want to be a little more reticent on selling there. And the risk reward certainly needs to pay for it. We see it all the time with people who fall in love with short puts and covered calls, and they keep forcing it to get a few more cents here or there, even though the risk reward isn't there. And of course, there are scenarios. Maybe you want to hedge your portfolio. Maybe you see a particular event coming up you want to trade around. It could be an earnings, could be something else out there. Maybe you want to speculate on that or hedge against it. There are a lot of scenarios. Maybe volatility is just extremely low, and there's enough movement in the underlying, if you're aggressive and hedge and scalp, that it pays for itself. And so in which case, in that scenario, you don't want to be dumping out a lot of premium. Gold recently, it comes to mind. That's a commodity that's had a very low level of volatility until recently, which has made it not very attractive from a selling perspective, but the underlying has moved enough. So if you bought it, you could do well just scalping it back and forth. So that's one example, and there are many. Dan, I know you kind of counsel a similar approach. You probably have had people come to you. You've heard that old saw too. 80% of whatever options expire worthless, so you should never buy them. All these ridiculous percentages people throw around out there. So what do you say when people come to you kind of espousing this myth that all options expire worthless and only pros only sell them, so I should never buy them?
Yeah, that's an interesting myth. And for a while I was wondering where the heck that came from, because there are a couple sources out there that compile data, and one of them is the OIC, the Options Industry Council. And their data says that is not true at all. It is decidedly not true that 80% of options expire worthless. In fact, they break it down. I want to say it's actually more like something like 30% or something like that. So where does this number come from? It actually came from the CME group, but they calculate it a little bit differently. They look at it a little bit differently. So the way OIC looks at it is any option that is ever listed, about 30% of them will ultimately expire worthless. But the way the CME group calculates it and looks at it is they say when an option is finally closed, like reaches the end of its life, what percentage of those options expire worthless, and that is about 80%. What CME doesn't account for is all the options that are closed. Like maybe somebody sells the option at $1 and later they buy it back at 20 cents, or they buy it at $1 and sell it for $2 later. most options are closed, like 60 or 65% are closed. So that's sort of the out trade, if you will. That's why we sort of get conflicting data. And to me, that data doesn't really mean anything to me anyway. It doesn't necessarily increase that doesn't imply that it increases your chances of making money by being an option seller at all. It's just the proximity of the strike price relative to where the stock is trading. So I don't know. I think if you're going to look at data, you can look at much more useful data that you can trade off of than worrying about what percentage of options expire worthless.
I think maybe I know we've touched on that in the past on the show. It might be time for a revisiting of that in a future episode. What do you think, Dan? Maybe we'll go out there to OIC and CME and get those exact numbers, and we'll put the lie to all these scammers out there who are filling up your inbox with 88% of options expire worthless. Why are you buying them, right? We'll hopefully save people some money there in the long. So let's maybe let's table further conversation on that for a future episode. I think that's one we could investigate further. But just know, listeners, that myth is busted. One of the more prevalent myths. I want to get it out there again because it is so common. Still, it's kind of scary that it still persists, but it does. We touched on it recently on an episode. We were talking about covered calls. Everyone out there loves the covered call. It's the go-to position. New stock traders, new option traders, they discover this and say, this is great. I can add an income stream on any underlying I want. Well, this is manna from heaven. This is magic. Why did I know about this earlier? And you tell those things. I've done this test myself. Dan, I bet you've done this test as well, right? You've been giving, let's say, a seminar or a lecture somewhere or a talk at an event, and you say, how many people out there will trade covered calls? And like 80% of the hands go up, right? And then you say, how many of those will trade short puts? And a couple of meek hands go up, right, because they're scared. Have you done that same test yourself?
Oh, yeah. Yep, all the time.
Yeah, it still happens. It's amazing. In 2019, that kind of stuff will still happen. And why do so few hands go up for the latter? Because everyone, almost to a person, thinks, oh, well, I'll do covered calls all day because it's covered. It's right there in the name. There's no risk. I already have the stock. I'm getting income. Bada boom. I'm happy. And then the short put, oh, my goodness, no. How could I ever but possibly conceive of such a risky position? Of course, listeners, the myth, the lie really comes in when you realize that, of course, and whenever I like doing this in person because you see people's eyes just get super wide because you've just blown their minds. But you tell them effectively, well, actually, if you're selling covered calls, you are selling short puts because risk, perspective, synthetics, they are exactly the same thing. And if you go look at the P&L graphs of these types of strategies for yourself, or go check out some of our earlier basic episodes on the short put and the covered call where we do full deep dives into them, you will see exactly what we're talking about. Put those two graphs next to each other. Put the short put and the covered call graph next to each other, the expiration P&L graph, and you'll be like, And then you'll scratch your chin for a little bit, and you'll say, I think I know what these guys are talking about now. So yes, it's that's a very important formative moment in people's options education. And it's an important one because the short put has its use, has its value, particularly if you're using limit buy and sell orders in the underlying. It's a great way to use it and get paid for it. And I'm not here to espouse everyone should go out there and just start blasting away on puts. That's not what I want at all. I just say people need to understand the true risk of what they're trading at the end of the day. And if they did that, maybe they'd be a little bit more reticent on forcing out that covered call when it really doesn't make sense, certainly from a risk-reward perspective and from a net premium perspective. They're doing it just because they think it's so low risk and they want to get a little bit extra premium. They probably wouldn't sell a put for that same level of premium. And if you wouldn't do that, then maybe you should hold off on the covered call as well. Dan, how often would you say that still to this day when you have new students coming to MTM that you encounter this pervasive myth, sir?
Yeah, I mean, all the time, really. There's definitely a lot of those sort of myths out there. But yeah, I mean, literally, like people come to me all the time in live presentations. When I hold the Q&A section at the end, I get that on webinars all the time.
Let me ask you this, because you're always doing these webinars and these events. What would you say still to this day is the most common myth, the most common misperception about options that you encounter? I mean, you're out there, you're doing your annual retreat, you're doing your regular webinars, you're in-person mentoring, you're online coaching, you're traveling abroad to educate people. Outside of the ones we just touched on, are there still is there still a very common, widely held myth that you encounter out there that you can't believe is still making the rounds of 2019?
Yeah, I mean, there's a bunch of them. It's kind of hard to say which one is the biggest one or what have you. You know, one that comes to mind right now is last year at our mastermind, which we had in Vegas, which is like it's a real select group of students where we trade live, you know. And we timed it just perfect because it was last year in, what was that, September, October, where the market just like was going crazy. Like the Dow, it was down like 500 points one day or something like that. It was just extremely volatile. And, you know, we traded live for 3 days, real money in like the worst market conditions. And we made money, but it was a very small, you know, it was a small amount of money because we're making like real trader trades. You know, we were not the ones you get those spammy emails about. We're being very conservative, managing our risk. And the one guy in the class, he's like, well, there was such movement. How come you weren't buying puts all the way down when the market fell? I'm like, you know what? That you can throw the dice and try and get lucky and be like one of these guys who sends you those spam emails, or you can be a real trader and grind out conservative profits. You know, which one do you want to be? So I don't know. I guess that's a little bit more of an example of sometimes how people think about options. That is a bit of a fallacy, or at least a really bad way to think about it, in my opinion.
All right, Mr. P. Unfortunately, that music means we'll have to leave the proving ground there for now. A lot more myths out there we want to get to, a lot more we want to talk about. Hopefully you're liking this boot camp coming at you a lot more frequently these days, because we like bringing it to you. It's a fun show. We want to have it back out there more active for you. So hopefully you guys are liking it. And Mr. P, let's say they like what you're talking about there with some of the mentoring, the classes, the online. Maybe they want to meet you in person. Maybe they want to do an online, in-person one. Maybe they want to come to your retreat. Maybe they want to do some of these, live trading you're talking about. Where should they go? What should they do, sir?
Yeah, we'd love to help you any way we can. You can always just visit our website, markettaker.com. We'd love to help.
There you go, listeners. Markettaker.com is the place to go. Put on that second T there to become a good trader. There we go. I just gave you a free tagline for you, Dan. All these years you've been doing it, I gave you a free tagline. Markettaker.com is the place to go. And we'll see you back here next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.